Hello everybody, so today I'm going to be talking about a strategy that I use in the stock market to pick my stocks that has led me from negative 10% loss on my portfolio to well over plus 45% plus profit in a span of 1 year. Now, I'm making this video not to tell my strategy so that people imitate my strategy. I'm simply making this video as an insight of how I trade my stocks, and plus I do not have a very extensive experience in the stock market since I've only been trading in the stock market since last year, February. So, I'm still relatively new to all of this. So I can't exactly say that this strategy always works, but as for now, it is working quite good. And so I just want to share it to you guys, and maybe for my future self to see, maybe there's some corrections that I can do in the future. So this is my initial investment on $397. I lost 10% of it because of very reckless investing decisions, and has led me to a nice 45% profit. Now this 45% profit isn't exactly pure 45%. It's actually the sum of the profit I got from my initial investment of $397 plus the additional $305 that I put in the middle of my investing journey, which is around March this year. So these are the key points that I normally go through in order to determine what the value of the stock is. Is it a buy? Is it a sell? And so on. So there are 6 of them. Now I'm gonna elaborate it in just a minute. So the first one is the market narrative and industry picking. Now this is quite straightforward. To be fair, if you have an interest in the stock market, that it will come very obvious for you what the market narrative or the industry that is being actively traded in the market right now. The reason for we want to watch to this key point very carefully is that because more market narrative, or more the more hot, the hotter this industry or this sector is being talked about in the stock market, the more market activity there is in the stock market. And the more market activity means that it's more likely that this sector adjusts itself, right, with the other key points. So what it means is that if this first key point, which is a market narrative, doesn't if you don't pass this first key point, the rest of the key points wouldn't be maximized. Now for market narrative, I will normally go to the classic Yahoo Finance, or any other article news platform there is. Another way to see which stocks are being actively traded is actually by looking at the screener in well, I actually just search it on Google here. It happens to be TradingView, but I basically just search stocks with the most volume throughout the day, and you just see which comes the most in the sector side here. So we got electronic technology, consumer durables, technology. So you can actually try to conclude that yes, the industry that is now being like actively traded is in the technology industry. And in this case, obviously we know in 2025 is going to be AI. And normally what I will do to diversify my portfolio is by looking at the major headline, which is AI, and just try to pick 2 industries or 3 industries that has correlations with each other. Let's say tech industries with health industries, but at the same time those health industries use AIs, or stuffs like that. So those stuffs has some correlations, but at the same time you are diversifying your portfolio, which is a good thing. All right, so moving on to the second key point, which is macroeconomy. Now this is a very important thing, obviously. Now there are normally I normally see the three major key points in the macroeconomy world, which is the interest rate, the Fed balance sheet, and the important public figures. The list goes on beyond these three key points. However, these are the three most important key points to pay attention to. So normally what you will do to understand the relationship between the macroeconomy world with the stock market is by actually understanding the workflow between each and every key points of the macroeconomy, the properties of the macroeconomy. So for example, the interest rate, lower interest rates is known to be better for the market and vice versa. Now, why is that? Because, well, low interest rate, meaning companies will need to pay less interest rate on their loans to the banks, which will obviously be good for their earnings, meaning people will have more sentiment, market will have more sentiment to that company, to companies in general in the US, and that will boost the market. The second one is the Fed balance sheet. Now, the higher balance sheet is, it is normally better for the market and vice versa. Now, the reason for this is because, well, if Fed has a higher balance sheet, that means it has more trust into the U.S. government and the long-term prospect of the U.S. government and the U.S. economy in general. And so there are more money flowing around in the bank that could be used as a loan for the companies, right? So that's a good thing. So the third one is the important public figures. Now this is quite straightforward, and I'm going to give you some example on that. So the first one is President Trump announces tariffs. Tariffs means export import between countries are going to be stalled. A lot of companies in the US are using imports stuffs to manufacture the thing, which means there are more money that the costs of production are going to increase based on this logic, which will result in inflation. Another example is Fed Powell speaks. Obviously, if it speaks and it gives some sort of hint on, like, let's say, an interest rate cut or maybe the balance sheet of the Fed and other macroeconomy properties and sectors, there could be a little bit of volatility in the market. Now, moving on to the third key point, which is the technical graph, options interest now and volume. This is where we get a little bit technical, and this is where I would normally use TradingView. I'm just going to use TradingView because it's what I've been using for as long as I can remember. Now, I'm assuming that we all here understand the classic, technical analysis fundamentals such as, support, resistance, some other classic indicators, like volume, momentum oscillators, exponential moving average. So I'm not really going to go deep into those stuffs, but rather what I'm trying to say is that it's very, very simple. Just buy low and sell high. I mean, that's that's the whole principle, right? All right, so the next half of the key points is the options interest and the options volume. Now, the reason why we want to see this, even though we don't even trade options, we don't even trade any derivatives, because it could be a benchmark of price where you should buy and where you should sell. So I normally will go to option charts, which is a website that I normally use to look at the charts of the option interests of a company, of a stock. Obviously, now I've opened one. Is a Lilly Ellie and Co. Company. This is a very well-known pharmaceuticals company in the US. And what I will normally do is I will normally separate calls and puts, and I normally will include the next 5 expiration dates until like probably the next like 1 month or 2 months. Now, the reason for this is because I'm thinking of holding the company and looking at the graphs for the next 1 and 2 months. So let's say if a person is a more long-term investor, then they will probably include more expiration days. So as you can see here, the underlying price as for now is $734. And I normally will go to this chart over here that will show the highest open interest options on the call options, because we have set it on the call options. And as you can see here, the open interest on $750 strike is the highest with $3,433. The underlying price is lower than the strike options, which means there are indeed rooms to grow according to the logic of this options interest. Now this is where it gets very interesting because the highest put options is actually at strike of $780, which is above the $734. Now, what I would normally use is the one below the underlying price that is still the highest one in the option interest table, which is here $700, which will expire on September 19th, 2025. With 3,446 contracts. So now I see the bottom line, and the upper line of the option interest. And I'll normally compare that with the resistance and the support lines in the graph in TradingView. So as you can see here, the $700 support lines that we have drawn here actually kind of reflects the actual support line of the graph itself, this 5 years graph of the stock. And for the resistance line, now this is where it gets a little bit fuzzy, and you can't exactly know what was happening here. But this, again, as I said before, you're just trying to compare and just, you don't draw conclusions. You just try to get as much insights as possible from technical analysis. All right, so moving on to the fourth key point of my strategy, which is earnings and financial of the company. Now, this is where you understand, okay, I've picked my stock. The stock definitely aligns with the industry that I'm picking. The macroeconomy is also developing really well. It's supporting the stock, and the technical analysis and the options interests are a lot along the lines of our own favor. There are a lot of properties into these financial of a company. If you go to, let's say, TradingView, is where you normally do your research on the financial of the company. I mean, there are a lot of things here that needs to be unpacked. I would normally, like, if I want to be fast and just straightforward, these are basically the three most important thing, in my opinion, that values a company. That so the first one is the PE ratio. This basically determines if a company is overvalued or not. PE ratio varies. It's very, very relative to the industry that you're in. Like, for example, here, Eli Lilly and Company, it has a price to earning ratio, the current PE ratio of 48. This in the pharmaceutical industry is considered quite high. Let's say VO, Novo Nordisk, which is also another pharmaceutical company. This one has a PE ratio of 15, right? So that's cheaper. Let's say Nvidia, right? Nvidia is a great company, great everything, but the PE ratio is even higher than the PE ratio of Lilly, of 58, right? But this is relatively a normal PE ratio for a tech company, especially a really fast growing tech company. Let's say Netflix, right? Netflix, we have, as you can see, 52. Amazon, now Amazon is a bit lower than that, which is at still it's quite high, 34. In comparison with the Lilly company. The whole concept is comparing in the same industry. The second thing is the EPS, earnings per share, revenue, and the net income growth, which obviously you can definitely see from the statements of the company. Here, as you can see, for the, I'll normally see the quarterly and the annual, both of them. And for the total revenue of the company, as you can see here, is averaging around, I would say, 20% growth, which is nice. It's still on the positive, and that's just a concept of stock market, right? You want to see the company grows. If there's no growth, there is no trust in the company. There's just no future in the company. Same thing goes with the net income. As you can see here, you get a nice net income of, it's quite volatile. However, as you can see, the TTM, the trailing 12-month net income, is 13 billion, which is up from the last year, which is still very nice. And for the EPS, normally I will see it at the earnings tab here, and you can see it has a really good surprise to, shows that the company is beating the expectations of the market more often. So the third one is the cash flow and intrinsic value of the company. Now, for people that don't know, intrinsic value of the company is basically saying that if I buy the company now, how many years will it take for the company to pay out their earnings so that it will cover the initial costs that I paid today. There are just a lot of ways to calculate this intrinsic value, such as the DCF method. This is used by a lot of analysts and Warren Buffett. We also have the Benjamin Graham's model, and a lot of other ways to actually calculate this intrinsic value of the company. If you want to know the cash flow of the company, you can definitely go here and go to the cash flow section. I'll use that free cash flow to input that into the formula of the calculation of intrinsic value. All right, so moving on to the fifth key point, which is the analysis sentiment and rating. Now, this is not necessarily the most important key point, as we know that the analysis sentiment and rating, they normally diverge a lot with how we invest. But I find it really good to just use it as a benchmark to see if the people there in the Wall Street are thinking the same way as us. To see this analysis sentiment and rating, there are a lot of sources, but one of my favorite sources, obviously, again, Yahoo Finance, because everything is just there. The top analysis section on the analysis tab. What are we in? Oh, NVIDIA, right, NVIDIA, and we see some ratings such as outperform, buy, out overweight with some price scores, stuff like that, with a price target of 155, 200, 225, and stuff like that. That makes sense because it's NVIDIA. But if you go to a lot of other stocks and stuffs, you will understand that it is actually quite insightful sometimes. Now, moving on to the next and the last key point, which is market sentiment, recent volumes, and news. Now, the reason why I add this sixth key point into the list is as a last resort to basically just convince myself that yes, this is what the market is wanting, this is the right stock to pick. But again, this is why it's also at the bottom of the list, because it comes at last. It comes from very subjective opinions. It comes from very real people. But yeah, this is how I invest my stocks in the stock market, how I pick my stocks in the stock market. And again, as I said before, as I said in the very beginning of this video, this is not as a way to spread my strategy so that people can imitate my strategy, because I do believe that everybody has their own strategy. And even more than that, I am still very much developing this strategy that I'm using to maximize my efficiency and my consistency. And I hope that it has maybe given some insights on how to look at the market and what actually important in the market. But yeah, I guess that's all. See ya.